Silver is not calm, it's coiled. Right now we're sitting in what I'm calling the 3.3x paper trap. Price is stuck in a 30% up, 30% down equilibrium zone, while paper claims at COMEX are more than 3 times the registered physical metal actually sitting in the vaults. I'm OG John AG, and in this video we're going to answer one question. With a 3.3.1 paper to metal setup, are we about to see silver rip 30% higher or get smashed 30% lower one last time before the real move? Let's get into the data. Segment 1, the 30% equilibrium trap explained. Look at where silver just came from and where it's stuck now. From the washout low around $63.90, silver ripped to roughly $93. That's about 30% up. From that high near 93, it dropped back to around $82, roughly 30% down from the top. Both sides got to say, "I told you so." Bulls saw a monster rally from the lows. Bears saw a brutal correction from the highs. The result? Price is now coiled in the middle, trapped between. Bulls saying, "This is dip buy value." Bears saying, "This is failed breakout, more downside coming." That's the equilibrium trap. Roughly 30% up from the bottom, roughly 30% down from the top. Both narratives alive, both sides loaded with conviction, and while they argue over candles, something much bigger broke under the surface. Segment 2, COMEX, the 3.3x paper trap. Here's where the title becomes real. On COMEX, registered silver, that's the metal actually labeled as available for delivery, just dropped below 100 million ounces for the first time in modern tracking. After a single day where nearly 5 million ounces were pulled out, registered is now around 98 million ounces. Now look at the March contract. March open interest is sitting around 65,000 contracts. Each contract is 5,000 ounces. 65,000 dollars is $5,000, 325 million ounces of paper claims. Do the math. 325 million ounces in March paper claims versus 98 million ounces in registered physical. That's a 3.3:1 ratio, 3.3 ounces promised on paper for every 1 ounce actually sitting in the registered pile, and the clock is ticking. First notice day for March is February 27th, about 2 weeks from the time of this analysis. This is why I call it a paper trap. If too many longs stand for delivery, the system has to rely on contract rolls, cash settlement, or levering up other sources just to avoid outright failure. Paper claims have outrun physical to the point where business as usual depends on nobody asking for too much metal at once. Segment 3, technicals, 150 EMA failed, risk of another leg down. Now let's talk pure technical structure for the short-term traders. On the hourly chart, previously silver reclaimed the 150 period exponential moving average, and we thought it might flip into support. As of this latest move, price is back below that 150 EMA. That means the test to turn the 150 EMA into support failed. As long as price stays under that moving average, it acts as resistance, not support. On paper, structurally, silver can go lower from here in the short term. The equilibrium trap doesn't guarantee immediate upside. It says we're coiled between outcomes. So the short-term picture, below 150 EMA, bearish structure for traders. Choppy range, stop hunts both ways. One more flush down into deeper value is absolutely on the table before any big squeeze. This is not a buy signal. This is tape reading education, so you don't get wrecked by pretending volatility is gone. Segment 4, physical versus paper, the $6 China premium. While COMEX plays paper games, the physical market is shouting. Current snapshot, Western spot silver around $82. Western futures around $82. Shanghai spot around $88. Shanghai futures around $90. That's roughly a $6 premium in China, and it has been holding steady from the last update. What does a sustained $6 premium mean? Eastern physical buyers are willing to pay more than the West says silver is worth on paper. Arbitrage hasn't closed it, which tells you either metal is tight or logistics, controls, and risk make that arbitrage non-trivial, or both. When paper market in the West sets the global benchmark price, but Eastern buyers keep paying above that price. That disconnect doesn't resolve quietly. It resolves with someone being forced to adjust sharply. Segment 5, 6 years of structural deficit, the slow squeeze. Now layer the fundamental backdrop on top of this. The Silver Institute just confirmed in their outlook we're heading into the 6th consecutive year of structural deficit. This year's projected deficit about 67 million ounces. Key numbers from that outlook. Investment demand up about 20% to 227 million ounces, a 3-year high. India expected to import roughly 220 million ounces by itself, about 25% of global annual mine supply, one single country. Industrial demand around 650 million ounces, down only towards 2%, mainly due to solar thrifting, still massive. Mine production up about 1% to around 820 million ounces. Recycling up about 7%, topping 200 million ounces for the first time since 2012. Even with increased production and recycling, demand still outpaces supply by 67 million ounces for the sixth year in a row. That means above-ground inventories are being drawn down year after year. The COMEX registered drop below 100 mirror isn't random. It's the exchange version of that structural drain. Paper can pretend surplus. Physical reality says deficit. Segment 6. Geopolitics, China walking away from U.S. debt. Zoom out further. Look at what China is doing with its U.S. exposure. Combined holdings of U.S. treasuries, stocks, and bonds are down to about $1.56 trillion, lowest in roughly 14 years. Excluding the Belgium-held treasuries, widely believed to be Chinese custodial accounts, that drops to about $1.16 trillion, also the lowest since 2008. Official Chinese treasury holdings fell by $6.1 billion in 1 month to around $682.6 billion. Reports now say China is urging banks to continue selling U.S. treasuries. Ask yourself, if the largest foreign holder of U.S. debt spends 14 years systematically reducing dollar exposure, where does that capital go? Answer: commodities, infrastructure, physical assets, strategic materials, including precious metals. This isn't a one-week trend. It's a multi-year repositioning away from pure U.S. paper assets. At the same time, the World Uncertainty Index just surged past 2020 pandemic highs and is now above the level seen in the 2008 financial crisis. In other words, we are living through one of the most uncertain macro periods in modern history. That uncertainty is colliding with structural silver deficits and a 3.3x paper-to-metal setup. Segment 7. Shanghai holiday, 8-day manipulation window. Now add timing. The Shanghai Metals Exchange is closing for Chinese New Year from Sunday, February 15th through Monday, February 23rd. That's 8 full days where the key Eastern physical market is closed. Historically, when Shanghai is dark, Western banks have a cleaner runway to push around paper prices without an active Eastern bid to absorb the selling. Past closures have lined up with aggressive paper smashes and mysterious volatility spikes to the downside. So you have COMEX sitting with 3.83x paper claims versus registered metal. First notice day for March coming on February 27th. Shanghai premium at $6 and front-month Chinese contract in record backwardation. Near-term silver more expensive than future delivery. Then Shanghai goes dark for 8 days. Short sellers know. Their best chance to push price down is when Eastern physical buyers are temporarily offline. They can hammer the paper market, trigger stop losses, scare weak hands out, and reduce the number of longs who will dare stand for delivery later. But here's what's different this time. China's silver market is already in extreme backwardation, driven by inventory stress. Investment bar demand and solar manufacturing are draining stockpiles faster than they can be refilled. Shorts are paying deferral fees to avoid delivering metal now. That's not normal. That's what shortage mechanics look like. Segment 8. Macro cracks, jobs, bankruptcies, defaults. Meanwhile, the macro recovery story is cracking. Key stress signals. The jobs worker gap has turned more negative, pointing to faster unemployment ahead as openings fall. 9 large U.S. companies filed for bankruptcy in just 1 week. Corporate bankruptcies are now at their highest levels since COVID. Consumer debt defaults hit around 4.8%, an 8-year high. Yet at the same time, silver is up roughly 150% over the past year. Gold is up around 76%. That's not a picture of healthy organic growth. That's currency debasement colliding with supply constraints, while the real economy quietly deteriorates. Ray Dalio has written about this in his big debt cycle work. Big debt crises rarely end with a gentle landing. They usually end with some mix of currency devaluation and financial repression, making nominal debt serviceable while destroying purchasing power. We are watching that script play out in real time. Silver is simply one of the most sensitive instruments reacting to it. Segment 9. Texas Coins, the state-level gold and silver IPO. One more development that almost no one in mainstream is talking about. Texas announced plans to produce its own gold and silver coins for IRA and 401k used for state residents. Initial batch will be commemorative, but the roadmap is clear. Larger batches for statewide retirement holdings. Scottsdale Mint involved in production. What does that mean? This is effectively gold and silver getting IPO'd to the masses at the state level. If Texas succeeds and other states like Florida, Wyoming, Montana follow, you could see tens of millions of retirement accounts gain approved direct access to physical precious metals. That creates a structural, long-term bid from retirement savings rotation into gold and silver. That's not day trader noise. That's system-level infrastructure. While paper barrels on COMEX are stacked 3.3 high for every ounce, states are building on-ramps for ordinary savers to own the real thing. Segment 10. Bearish case versus bullish pressure. To be fair, we need the bearish case on the table too. The system still has tools. March contracts can roll into May. Cash settlement can be enforced in certain cases to avoid delivery crunch. Shanghai's 8-day closure gives Western paper markets a valuable window to push price down without immediate Eastern resistance. The break below the 150 EMA on the hourly is a real technical warning. Short-term traders are justified in being cautious until that level is reclaimed. Corporate bankruptcies and defaults, while elevated, are not yet full crisis levels. We could slog through a stagflation grind for a while. Paper manipulation has survived decades despite recurring tightness and physical. The establishment has contained these situations repeatedly, so yes, silver can retest lower. We could get a brutal shakeout before any big upside resolution. Traders who ignore technicals can absolutely get steamrolled. But here's the counterweight. February deliveries already exceeded 100% of open interest, a rare event. March sits at 325 million ounces of paper claims against 98 million registered. India is importing 25% of global mine supply. We have 6 consecutive years of deficit. Investment demand is up 20%. China is in record backwardation and paying premiums just to roll and avoid delivery. These are not memes. They are documented data points from the Silver Institute, COMEX stats, Shanghai futures data, and state-level announcements. When paper claims run 3.31 over physical and real-world demand plus deficits keep eating inventory, equilibrium doesn't last forever. It breaks. Segment 11. What you should actually watch now. So what matters from here? Key checkpoints. February 15, 23. Shanghai Metals Exchange closed. Watch how Western paper behaves in that window. February 27th. First notice day for March. COMEX silver. See how many contracts roll, how many stand for delivery. Does March open interest shrink sharply, or do longs dig in? Shanghai premium when markets reopen? Does the $6 premium narrow, stay, or blow out further? Backwardation? Does front-month Chinese silver remain at a record premium to later months? Or does that stress ease? 150 EMA on the hourly. Does silver reclaim it with conviction, bullish repair, or keep failing below, bearish pressure? COMEX registered inventories. Do they keep falling below 98 M, or do they stabilize, restore? You don't have to predict. You have to observe and be prepared. Closing, 30% up, 30% down, calm before the break. Right now, silver is 30% above the washout low, 30% below the spike high, sitting in the middle of a range that looks calm on a daily chart, while underneath, COMEX is at 3.3x paper claims over registered metal. China is paying a $6 premium and sitting in record backwardation. India is absorbing a quarter of annual mine supply. The Silver Institute is logging the 6th straight deficit. China is unloading U.S. debt. States like Texas are building direct precious metal access for retirement accounts. Call that equilibrium if you want. I call it a coiled spring. You've been watching John AG here, and I'm OG John AG. If this helped you see why this calm might be the calm before the break, hit like so this doesn't get buried under hopium and doom porn. Smash subscribe and turn on all notifications. We're going to track these COMEX and Shanghai checkpoints day by day. And drop a comment. 30% up or 30% down? Tell me which side you believe in after seeing the data. And more importantly, tell me why. Because here, we don't trade vibes. We trade facts.